Hey, deal makers, welcome to the show where it's all about financial freedom with real estate. Let's do this. So, with the year coming to an end, it's time we look back over 2024 and let's just see what happened in real estate overall and multifamily specifically. We're going to take a look at the single family housing market. We're going to talk about the multifamily market, of course, and rent trends, interest rate trends, vacancy trends, transaction volume, ability to get deals done, all that nature. I'm going to have Garrett here on shortly, and we're going to riff around what we saw happening in 2024. Now, quick shout out before we get into that to Paige, who left a fantastic review on the podcast on iTunes. He or she, well, I think she said, if you're looking to dip your toes in the real estate investment pool, this podcast is a great place to start. I've gained an amazing amount of knowledge from the show, both from Michael and his guests. Every episode has something valuable to offer. Thank you. Awesome. So thank you for listening, Paige. Appreciate it. If you enjoyed it, show, leave us a review on iTunes for the iTunes for the podcast, and maybe we'll shout you out in the next podcast as well. Would love to hear from you. With that, let's bring on our co-host Garrett Lynch. What's going on?
What's going on, Michael?
All right, so we want to kind of see what went on in 2024, and while we normally don't talk about the housing market in general, I just want to shine a light on it because it may or may not really affect us, and so I kind of want to draw that out. But the 24, just the housing market in general, currently really stabilized over 23, and the listings, actually, the number of active listings grew by 29% this year, which is cool. Medium home prices stayed stable throughout the year at 425, which is interesting because interest rates went up even though a little bit more. So that's interesting as well. It seems to indicate demand. Interest rates, mortgage rates hovered above 6%. Homes started, though, moving at a slower pace this year. And they averaged 58 days on the market in October, which is the slowest for that month in 5 years. So in general, to what degree should we as multifamily investors pay attention to the housing market?
So I think on this topic, multifamily investors should pay attention to the housing market and in the fact as to how much supply is on the market. So there's a lot of supply and pricing is down. It means that it's more affordable for people to buy a home. I think a lot of people that live in apartments are living there because they have to, maybe not because they want to. Although there are some that love it. But if there is an opportunity to go buy a house and that gap is really wide and they can't afford to do so, they're going to rent. And so you're going to have that pent up demand in general. And so if the supply goes really wide and you have all these houses hitting the market, obviously that's going to cause pricing to come down. It makes it more affordable for people to buy homes, which is a good thing. But there may be less renters in that specific submarket or whatever else is going on in that market.
And there was an article recently, about 2 or 3 months ago in the Wall Street Journal, talking about the gap between owning and renting a home. And that gap literally in 24 was the largest it's been in a long time, I mean, the graph is crazy, which means that buying a house right now is so much, the mortgage payment is so much higher than the rent payment on a comparable home. And normally they're trailing each other. They're this, that. It's always more preferable to own a home. But to your point, if it's so much more expensive, right? The average mortgage rate, average monthly new home payment, $3,000 per month, and the average monthly new lease payment, according to these notes, is $2,000 per month. That's a giant gap in 24. And so that, of course, is good for rentals. And like you said, if there's a higher supply of homes on the market and that gap starts to close, then that's not as good for rentals.
So the viability of apartments as an asset class it's there. It's very viable, despite everything else that's gone on in recent years with interest rates going crazy, with insurance going up, with the costs going up, all those things. The demand is there. This points to that. So that large housing gap, how do you solve for that? I mean, the one obvious issue is to create more supply, but it really, until interest rates go down, a lot of people are going to be sitting inside of their homes because they got a 3.5% rate just a couple years ago, and they don't want to go sell into something else at a 7% or 8% rate right now, right? So you're also not going to catch up with just building. I don't think. I think that's a major issue, is a supply issue in general. But as long as that gap exists, especially at the level that it's at right now, you're going to have pent up demand for apartments. So you're going to absorb those new deliveries. And if you're not looking at just the A class, then you have your other class of assets that are going to be full, and vacancy should start to go down because you have this situation of that gap is definitely proving out the viability of this as an alternative asset.
Yeah. I mean, the one asset class that was in the news for much of the year was office space, right? And it's, COVID never really, I mean, it's been in the news for a while now, really deep distress. And I wonder if that's changing now.
The thing is, I don't know that we can point to that as changing that. There's not great data saying, oh, all these people are going back to their office jobs or whatever it is. We can point to data in multifamily though that there's that gap, right? So that's really strong data that there is that demand to rent. Office work, I don't know where that data exists. Maybe there is some out there. There's people returning to work. Companies are forcing people to do so. I think there's a permanent shift to remote work, and I think that's in the job market in general. That's just the new trend. Does it go back? Maybe a little. Now that COVID's gone, all that, but you saw a lot of people shift out of the office world during COVID. They're happy at home. They can work from home. This whole thing, it's like a movement, and so office. There's going to be pricing that's down in office, where there's opportunity to come in and improve it and create the shiny new object. And I'm sure you'll fill that up. I know people that are doing that right now, but in general, the asset class as a whole is in the hurt locker, and I don't see a quick way out of that.
Yeah, it's gonna take a minute. And in the meantime, a lot of it is vacant, and some of it is actually being converted to other types of uses, interestingly. So I think you're right. It is gonna take a little minute. Now, one of the things that was different this year was that we had relatively stable interest rates. In fact, they went down a little bit versus 23 was wild, right? So stable interest rates, what does that do? I mean, I want to see how that affects the multifamily asset class. Number one is in general, how has that affected the market with regards to prices, let's say?
Yeah, so I agree. It's been more stable this last year. So you've seen it's still been volatile somewhat, but in general, it's been around the same level. So the Treasury now I think sits at like a 420 or something. And it's fluctuated between 420 and like 380, like somewhere in that range. You've seen it. So what that does is you're seeing trends. When things are volatile,
Mhm.
it's very difficult to transact, first of all, because your pricing is largely dictated based on what kind of loan you can get, right? So if you have to go get a 9% bridge loan on a deal because it's not performing, you're going to pay much less on that than you would an agency loan, right? But if your agency debt is not attractive, it's attractive one day and then the next day it's not, which is what we've been seeing really a lot in 2023, then it's hard to land that. It's hard for transactions to happen. It's hard for trades to happen. So everyone's just kind of locking in. And even if there was a deal that went under contract, you're expecting to get retraded at some point, which makes it very difficult to get anything done. And so you see this year, there were more transactions in general than last year, just because you could predict it a little better than what you were seeing before. The movement, yeah, there was movement. We were in a deal earlier in the year. There was movement. I put a clause in our contract that said if it goes up too high, we can get out. It did go up that high, but then it retracted, but it kind of stayed around the same level. So now you know that you can go into a deal, and as long as the deal makes sense, that you're probably going to be able to land the debt in a 2 month period. And I think that was the biggest difference between this year and last year.
That was a major risk, is the debt moving against you very quickly. So you put it under contract, you're getting quotes from your lenders, it's whatever it is, and then by the time you're closing, it's significantly higher, and it reduces your loan proceeds. And now the risk is that the fact that not the last one we bought was at risk. In fact, we did in fact go ahead and move, even though it moved against us, and that was for a period of about 9 months, a major, maybe even more, 12 months, a major risk. Now, one of the ways that the lenders reacted to all this volatility and uncertainty was they cut loan to value significantly last year. I mean, down to like 65% loan to value. You can't finance construction costs anymore. That went out the window. And I'm wondering, are you seeing that relaxed, or do you think that's going to get relaxed? So even if interest rates stay exactly the same, but there's more stability and more predictability, do you see that loan to value starting to float back up to
It
maybe
already has.
it already has?
So we've seen loan to value. Now, then this is another byproduct. Very good point, Michael, of the stability on in the market and even uh, people looking at interest rates potentially coming down is you're seeing lenders get more comfortable. So that one of their ways to lower their risk profile is to lower leverage. So they're putting less on the streets. Now they're more comfortable. And so the byproduct of that is we're seeing 75%
Mhm.
LTVs, even maybe up to 77 we've seen in some cases. And so that's really helpful as a multifamily owner if you're trying to refinance, you're trying to acquire new deals. Obviously, go with whatever level you feel comfortable with for your investment. And lower leverage is definitely more conservative, but it's cheaper money. And so, as long as you feel confident with your debt product and you're able to make the mortgage payments with a fixed rate or floating, but realistically fixed is what you're seeing now. It's attractive to go and get these agency loans at 5.5% with 75% leverage and go to deals. And now it makes everything just more viable. You don't have to
So
come with as much equity in an environment where it's difficult to find equity.
well, okay, but to that point then. So obviously interest rate goes down, then prices go up because the cost of capital is lower. But if the LTV goes up, will that not also increase the prices?
Yeah. Yes. It
So
will
I mean,
slightly.
the argument I'm trying to make here is if interest rates simply stay the same, then prices will likely start to increase just simply because of the fact we're in a more stable environment.
Yeah, yeah, I agree with that. I think pricing in general right now with what we've seen, it's not at the levels as low as they were in, let's say, 2020, really.
Right. Yeah, of course.
You're seeing pricing above that and this year. And so is it that much higher than where it was in 2023? Probably not. But it has gone up a bit and it's kind of like holding steady, is at least what we're seeing. And that is a factor, absolutely, is the amount of leverage that you can get.
Let's pivot a little bit to rents, vacancies, that kind of stuff. So the actual people living in there. And in the 22 rents, when the interest rates went up by 9%, where inflation was up by 9%, the rents went up by like 25% in large parts of the South and Texas and Atlanta. Certainly, it was wild. It was crazy. And then, of course, last year they slowed down considerably, including in this year. And a factor, I think one factor was that we had a huge run up previously. So it had to come down a little bit because the run up was unsustainable when rents normally grow by 3% a year and it went up by 25%, obviously. But there was also a lot of construction that hit in 24, stuff that was started 2, 3 years ago that started coming out this year through probably the middle of 25. And in some markets and some properties, that put some pressure on the rents as well. So what did you see? What do we see in our portfolio around 2,000 units? What do we see in regards to rents and vacancies?
So when it first started happening, it was, I think realistically, we were seeing it start to happen in 2022, where rents were coming down. We were going to acquire a deal and we saw the rents start to slip and we're like, oh, maybe it's around the holidays. It was like the holidays of 2022, things slow down, whatever. And then it just continued to fall. And then we were like, whoa, what's going on? And then you got in 2023 and you're seeing rents fall further and it's happening everywhere. And so we started to investigate, like, why is this happening? This is crazy because there's still demand to live in apartments. Doesn't make sense. Well, exactly what you said. During COVID, interest rates were super low. And so there were a lot of new starts, a lot of new development starts in multifamily because it's like, hey, this cheap free money, let's go build. And then when those those are variable rate loans, interest rates went up faster than they've ever have in history. Oh, shoot. But they still have these things going, so they have to deliver them. So now the deliveries are starting to hit now. Last year we had a lot of deliveries hit, and then they're hitting all this year. And so people that are in B class apartments, they can go live in an A class for the same price. Why wouldn't they? So there's this absorption issue, and it's not just in our markets; it's everywhere. Actually, we had one market that saw a decent amount of that, and another market that was completely fine. So it is by market, but a lot of the major metros got hit the hardest because that's where you're seeing a lot of the building, as people want to be there, right? So you have this major oversupply issue going on. And that is really the main cause of the rents. Now, the demand is still there to live in apartments. And what we think is going to happen, and based on the data that we've seen, is that these new starts stopped when interest rates went up because now all the money was super expensive. So it all stopped, it halted, and now there's going to be an undersupply issue. So it's going to catch up. It's going to catch itself. It's going to take a couple years to get through that, and then you should start to see rents tick up. This year specifically, we've seen rents kind of stay flat, not really, not decrease too much. They kind of think the major decrease event was maybe 2023. We saw a lot there. This year it's been flat. You can still create value and raise rents, but it's challenging to get that organically, and that should start to subside hopefully next year, and years following for sure.
Yeah, so I mean, there's still continued on a demand. It's just where are they going, right? If you can rent a
Mhm.
Class A for the same price as Class B, why would you not? Now, Class C, is that a little more insulated, you think, from a lot of the housing, or is it also affected?
I think it's all affected. Uh, in general, I think you're seeing because it's affecting pricing in all asset classes, all the way down to D class even. And so it starts to A, the B's move up to the A's, the C's move up to the B's, et cetera. And so you're seeing an impact across everything. I think the C class, if anything, are in a worse state right now from what we've seen in general, just because then you have operational challenges. If you're in especially if you're in a C or D class area, there's all kinds of other variables that are happening aside from the fact that you can't get the rents that you need, right? So you have that layer in there. And what you saw a lot of people doing is they wouldn't underwrite enough economic vacancy in there, and then their economic vacancy is through the roof, and especially in a down environment. And so those are the ones that are going back to the banks first, the C class and D class deals in bad areas mostly. And so that's where I've seen and heard those types of deals failing and going back. That's probably the worst place to be in a bad area with a C class deal. We've bought C class assets, but they're in typically like in the A locations. And as long as you can manage them, and the maintenance and things like that, they're great.
Yeah, so this year has been a year of stabilization, I would say. I mean, certainly forward 23, which was absolutely chaotic in so many different ways, things changing literally by the week. And 24 has stabilized a little bit. We're starting to see a little bit more transaction volume. We actually have a deal under contract right now in a suburb of Atlanta. Check that out at nighthawkequity.com/Waverly is the property. So /Waverly. And check that out if you want to invest passively in that deal. Would love to show that to you as well. It is a 506C, so we can talk about it. Put up billboards on the side of the road. And we are seeing some transaction volume, but nevertheless, this is only our second deal this year. What's your outlook for transaction volume, Garrett, for next year?
So I'll start with this year. We've seen a lot of people pick up deals. So a lot of our peers in the space that were not doing deals last year, everybody's got a deal this year, which is really cool to see. It's great to see things being turned back on, people understanding that pricing is down 30 to 50% in the market from where it was at the peak. So I think that's really attractive in general. And I think anything you bought last year, this year, likely you're gonna win on those, as long as you can do the right thing on that and you've set the capital stack up right, because pricing was just it's just down. I don't know if I forecast in 2025 a giant drop off, especially with the new administration and everything that's coming. Uh, I don't see it crashing. There's always the chance that okay, that, something could happen and things could crash out and all that. But I think we've gone through the worst of it. And so you're seeing 2024 stabilizing a bit with the volatility. Next year, it's probably going to be another close to stable year if we're being realistic with it. So there will be more deals to be had, and it's a really good time to get in and invest this year, next year. And then I think in 2026 is when you'll start to see things tick back up. We could see signs of it late next year. I don't know. But realistically, I think next year will probably be very similar to this year.
Yeah, much more stability, mild growth. I think rent projections nationwide is on between 1% and 3%, depending on where you are, which is kind of back to normal, which is kind of cool. get some transactions volume. The one good thing is we don't no longer have non-refundable deposits, so that's kind of fun. We had to do that a little more balanced, more stable interest rate environment. I think we're going to see a slight uptick in prices due to stability and potential increase in loan to value. That's going to be kind of nice as well. So it feels like to me we are rounding or have just rounded the corner.
Yeah, I think that we're through the thick of most of it. Now, one thing to look out for is the lenders that have made deals with a lot of operators in general that had variable rate loans. Those deals only go for so long, right? So that's something to look out for. Maybe that you'll see more distress in that side if people run out of time and the market hasn't recovered. If the We really need to see the treasury come down a bit on existing deals that were purchased in 2020, 2022 that were on variable rate loans. You really got to see some kind of retraction in the next coming years to feel comfortable that you can get a refinance done and get out. And the longer that it stretches out at the level that it's at right now, and with the treasury or SOFR, the more chance it is that those things could be in a state of distress, go into foreclosure, et cetera. So time is not your friend when it comes to existing deals that are on variable rate loans with bridge lenders. Now, that being said, in this environment, you're seeing a lot of people pick up deals with fixed rate debt because they're like, oh, I learned from that. I don't want to go back into that. So they're coming in they're being smarter about it. The risk profile of the assets right now, the same asset now versus 2 years ago, is completely different and in your favor as an investor. And the reason for that is because you have still lower leverage. It's not up 80% plus your capex. And you have a lot of people doing your fixed rate loans, which the advantage to that is what you're paying on your mortgage. So I'm going to pay this every single month through the life of the deal. There's no variability to it. Variability was okay when things were down and you could predict the interest rates a little better, but then it got slammed. Everyone got slammed when it rose, right? So you don't have that factor in anymore. There's more equity coming into deals, a little bit lower leverage, fixed rates. All these things make the deal more viable, and they make them more able to succeed in the long term. And it allows your operator to execute their business plan in an easier way. They're flush with cash. They don't have to be stressed about the mortgage. They don't have to be stressed about variable rates going crazy. All those things make the risk profile much better in general, in my opinion.
Yeah, so now it might be a good time to buy. And I always say, don't try to time the market. Figure out how to get into it, adjust your tactics as you go along. But if I were to time the market, right now seems to be a good time to get in for all these reasons we just mentioned. I mean, you just brought up risk profile, which is fantastic. The risk profile now is completely different than it was 2 years ago, right? Much more lower leverage, fixed interest rate, much different. Also, the interest outlook is completely different as well. The interest outlook is flat to down. 2 years ago, everybody agreed it was up, right? We just didn't know it was going to go up 11 times in a row, right? And so therefore, we already knew 2 years ago that we were towards the top of the market cycle, and we're all underwriting, the rising cap rates and things of that nature. That's all fine. And now we're trying to figure out how do we underwrite these deals, right? Because we feel like we're towards the bottom of the market. Should we be a little more aggressive on underwriting? We're like, yeah, maybe we'll project stability. But the point is this: we seem to be in a completely different market cycle than 2 years ago, which normally takes 5 to 10 years from one swing to another. I mean, look at the swing from 2015 to 2020, 2013, really. It was like 5 to 7 years until COVID hit. And then, of course, it changed everything. So the market's been very wild. And obviously, like you said, unless something happens, we're looking at stability again next year. And then, because if you look at the permits that were pulled over the last 18 months, they're down like 81%. So if you look at the housing starts, I'm sorry, the deliveries, they're going to start drying up towards the end of 25 and certainly into 26. There's nothing new being built. Why? Because no developer's making money with it anymore. And so you're not going to get that supply anymore. And so people are going to have to live with what exists out there. So to me, it feels like we're towards the bottom of the market. We're acquiring deals. We have more access to deals at a lower risk profile. And so it is a great time to get into it. So if you are ready to jump into it, now's a good time to do it. If you want to invest passively, right? If you want us passively, then check us out on the educational side and check out our mentoring program. You want to go to thefreedompodcast.com, because everything on one page now, thefreedompodcast.com, and look at our Apartments 101 Masterclass for a free training on apartments, how you go from single family to multifamily. But if you want to invest passive with us at Nighthawk, also go to thefreedompodcast.com and check out Nighthawk there and book a call with us. Get on our list so we can share with you some of our upcoming opportunities that we have as well. So the next step from this is the thefreedompodcast.com. We'd love to have a conversation with you. So that's our market update for 2024, kind of looking back. And in January, I'll do one looking forward to 2025, when we'll throw a lot more data at you and really kind of hone in on what we think is going to happen in 25. So with that, catch you all later.